Ever felt that deep, gut-wrenching tension when checking your portfolio, like stepping onto a rickety bridge over shark-infested waters? It doesn't have to be that way. You're about to uncover how seasoned pros sidestep carnage and transform nail-biting market dives into slick profit pivots. No guesswork, no empty hype, just proven tactics that give you an edge and keep your trading account from turning into an expensive bonfire. First off, let's crush the myth that everyone's getting rich except you. That's a lie the market loves to whisper. Picture it. A hot stock streaks upward. Your neighbor won't shut up about his easy gains, and suddenly your fear of missing out is screaming, "Buy, buy, buy!" Then, thud, it all comes crashing down. The lesson? Never follow the herd blindly. When the crowd stampedes toward a sure thing, they're often rushing toward a cliff. Instead, step back and verify. Check real numbers, not just gossip. If the fundamentals are flimsy, and the only thing propping up the price is hype, you're flirting with disaster. Next, embrace your secret weapon, stop-loss orders. Think of them as your financial airbags. If the price plunges below a certain point, your position closes automatically, saving you from a deeper crater. It might sting a bit to take a small loss, but it hurts far less than getting steamrolled by an unstoppable downward spiral. On the flip side, set profit targets. Imagine you're planning a trip with exact pit stops for fuel. When the stock hits your target, you lock in gains and walk away before greed convinces you that maybe, just maybe, the rocket will climb forever. Spoiler alert, it won't. Now let's talk about diversification, the art of not putting all your eggs in one very tempting but potentially explosive basket. Think of your portfolio as a superhero squad. If Iron Man, tech stocks, stumbles, Captain America, blue chips, or Black Widow, defensive stocks, can pick up the slack. Throw in a mystic element, like bonds or commodities, to balance the cosmic scales. Diversifying might not sound flashy, but it's like having a financial insurance policy built into your strategy. And here's a secret many amateurs miss: proper research. If you're not reading earnings reports, glancing at balance sheets, or checking out industry trends, you're basically betting on a horse because it looks pretty. Don't get dazzled by a hot ticker symbol or a flashy CEO interview. Dig into the numbers. Is the company consistently profitable? Are they swimming in debt? Are they the trendsetter in their industry or just another wannabe playing catch-up? Peel back the curtain on these metrics and you'll spot red flags long before they set your profits ablaze. Let's talk timing. No, not timing the market in a mystical sense. No one can predict the future with 100% accuracy. But you can improve your odds by using reliable indicators. Maybe it's analyzing moving averages, volume trends, or the dreaded fear and greed index. Even a basic understanding of technical signals can spare you from charging into a trade at the worst possible moment. Don't be the person who buys right before a bubble bursts simply because the chart looks like a never-ending ski slope going up. And then there's the biggest monster in the room, your emotions. Fear, greed, panic, they're like financial vampires that drain your rationality drop by drop. Picture yourself in a sudden market downturn. People are screaming sell on every corner. Do you join the panicked exodus and dump quality stocks at bargain basement prices? Or do you use your head, review the facts, and see if this is actually a golden opportunity to scoop up solid assets on the cheap? The difference between pros and rookies often comes down to emotional discipline. The pros know that sticking to their plan, rather than playing whack-a-mole with knee-jerk reactions, keeps their accounts healthy. Speaking of plans, treat your trading strategy like a well-rehearsed battle script, not an improv comedy show. Define your entry and exit points before you hit that buy button. What's your maximum loss tolerance? Write it down. What's your realistic profit target? Lock it in. When the chaos of the trading day tempts you to tear up your rulebook, that's when discipline matters most. Letting emotions run the show is like letting a hyperactive toddler drive a Formula One car. It won't end well. And if you think you can just press buy and pray, think again. Evolve like a tech startup. Keep learning, keep refining your strategy. The market changes faster than a fashion trend. Yesterday's winning formula might be tomorrow's embarrassing relic. Follow economic news, monitor global events, and pay attention to interest rates and currency fluctuations. A trade that looked genius when oil was cheap may flop when energy prices spike. Adapting your plan to new information isn't weakness. It's survival of the smartest. Don't hesitate to look at what successful traders do. No, not to copy them blindly, but to understand their logic. See how they manage risk, how they position themselves in uncertain times, and how they stick to their strategies like glue. Borrow their good habits, turn them into your own personal code of conduct. And if a particular strategy stops working, don't cling to it like a security blanket. Let it go, rework it, find something that fits the new market reality. Ultimately, avoiding catastrophic losses and turning consistent profits isn't some secret formula guarded by gatekeepers. It's about aligning your tactics with the market's rules. Control risk, diversify. Research companies like a detective. Respect your own boundaries and keep emotions locked in the trunk instead of letting them ride shotgun. Over time, these habits compound, and what once felt like a stormy voyage becomes a smooth cruise. Keep evolving, stay sharp, and watch as the market's roller coaster turns from a source of dread into a carefully managed playground for your money.